apparently we have an unofficial election campaign going on where the Prime Minister Morrison and the opposition leader Shorten are pitching how they're going to look after us better than the other. I have not been buying that for many years. I don't believe any one of them. You'll see shortly that Morrison is promising to create 1,250,000 jobs in the next 5 years. And anyone cares to guess what the immigration rate is expected to be in the next 5 years? Well, it's close to $2 million. So what he's saying is that we're going to bring in close to 2 million people, and we're going to give most of them a job. Obviously, there are people who won't be able to work, or maybe retirement age, and obviously children. So pretty much he's saying we'll bring all the people in, and most of you will have a job, which means that the net employment is going to be zero, and that's him promising something which we know is probably not going to happen. So that doesn't sound too good when you put it that way, I'm sorry. But yeah, have a look at this, and there's also going to be some predictions of the property 2019 from quote-unquote experts.
The unofficial election campaign is in full swing, with both sides claiming to be better money managers. The Prime Minister is pledging more than 1 million jobs over 5 years and a budget surplus. Bill Shorten's dangling tax cuts for Middle Australia while wiping out debt. But a slowing global economy is challenging policymakers all over the world, and a debt-laden Australia is no exception. Our finance correspondent.
Australian households can count on one certainty: there's a federal election coming.
So today I'm making a new jobs pledge from me to the Australian people to see 1.25 million new jobs created over the next 5 years.
Okay, dear fellow Australians, that was your Prime Minister, Scott Morrison. Let's see how long he lasts, but he just doesn't look prime ministerial to me.
Household spending power has been seriously blunted by debt and weak wages growth. They account for more than half the economy. Now many are witnessing their house prices falling, adding to the risks.
If we start to feel that house price decline seeping into consumer behaviour, then we could see a bit of a snowball in that regard.
I think, as Vimal noted, the US Federal Reserve are going to be on pause with the interest rate hikes, but as quantitative tightening continues, it's going to be quite hard for markets to continue on a sustainable uptrend as we really see quantitative tightening as, I guess, a stealth drain on liquidity and tightening of global financial conditions.
Well, that tightening of global financial conditions is certainly playing out in the property market in Australia, and for domestic reasons as well. Louis Christopher, what are you expecting to see in the property market? How low can we go here?
Well, indeed it has. Tighter credit has affected the housing market here in Australia really since mid-2017, and it's likely to continue to do so well into 2019. Our expectation is that dwelling prices will continue to fall. We think prices will fall somewhere between 4 to 6% nationwide, with Sydney and Melbourne leading the declines.
When you say
now 4 to 6% further declines in property prices. Louis Christopher is founder of SQM Research. I don't really know what that means. I could make myself a company and call myself a founder of some sort of research. What sort of data points is he using? Or is he just playing safe, 4 to 6%? I mean, that's kind of, just, it's not going to be too bad. Nothing to worry about. Yeah, it's just going to continue. And everything else, Louis Christopher says here, from another me, someone who is definitely not an expert, to someone who I suppose claims to be an expert and has a research firm, is a founder of it. Just pay close attention to the language of I'm saying something but I really don't know what I'm saying. And to be fair to Louis Christopher, is that the rest of the panel here that I may share with you in this forum of panel don't really know what's going to happen. They're kind of just feeling that maybe it's going to be choppy, it's going to be volatile, you're going to have to play a defensive game. That sort of wording is going to go around these comments now at the beginning of 2019 when they are asked what we can expect in the rest of for the rest of 2019. So again, to be fair, I think everyone's pulling their figures out of the air. So is he. But yeah, let's see what property-wise, what Luke Christopher tells us is going to happen in the future.
Sydney and Melbourne leading the declines. We've already seen Sydney prices down on average around 11% from the peak. How far can prices fall in these two big markets, and when are you calling the bottom?
Well, our forecast is that prices will fall in Sydney and Melbourne somewhere between 6 to 9% this year. So that would take the total peak to trough declines for those two cities somewhere between 15 to 20%. Now, we are probably around the midway point of this downturn now. We do not believe we will see a bottom in the market this year. I think the odds are that we may well see it sometime in 2020. But let's keep in mind now that APRA is taking a different view of the world. APRA is looking to loosen credit to the housing sector. They started this off last year, and indeed just prior to Christmas, they lifted the threshold on interest-only lending. That was effectively the final straw for the market back in mid-2017, if you recall. I think there'll be another move by APRA this year to try and loosen things up a bit more. And if we were to see, for example, a rate cut later this year, combined with that loosening, we could potentially see a bottom in the market later in 2019.
Well, you mentioned a rate cut, and Vimal Gaul, you were talking about the US Fed's more neutral stance on interest rates. Is the RBA going to be forced to change its optimistic tone on interest rates?
I don't think they would like to, but they might be forced to the table if there was a more material slowdown across the world, or if the housing market slowdown that we're seeing in Australia got a little bit disorderly. So I don't think it's something they want to do, but if they do move once, you know they'll be moving more than that. And the market has a slight chance priced in that they will be delivering cuts at some point in the future.
And Eleanor Craig, do you agree with that view? Markets are pricing in around 50 to 60% of markets pricing in a cut. Are you in that camp?
Yeah, so I think exactly as you say, markets are now pricing in around a 60% chance of a cut, especially after today's very poor business conditions survey. I think a couple of weeks ago we got a very poor consumer confidence survey result as well, particularly in New South Wales, which is where that sting of property declines have been felt. And I think as the year progresses and the local economy continues to deteriorate, given that we also believe that the housing slide will continue into the back end of this year, that the RBA will be forced into a corner where they have no option but to cut the rates. I think, though, looking more in the near term into February, it's quite likely that sort of the strong employment report that we got last week gives the RBA some bandwidth to just maintain their rhetoric and maybe just adjust those forecasts at the moment. It's going to take them a couple of quarters to really start revising down their policy expectations.
You know how Reserve Bank tells us that the housing prices are not the only thing, and far from the only thing that they use when they make decisions on interest rates policies. Well, it doesn't look like it. Looks like the market's really unwinding, property market, and they may actually have to cut the official interest rates. Market saying 60% chance of that happening. Some really kind of serious comments there that there's a problem, especially in New South Wales, as far as the housing prices. So it's not really looking good. But I will make another comment, is that somehow this downturn has now been going on for about a year and a half. And Luke Christopher, for example, says that we'll probably see the bottom at halfway through the next year, so halfway through to 2020. Now, again, what is he basing that on? Why do we think that the small 20 to 30% downturn can be over in 2.5 years, when it will be 20 to 30%, yet the house prices have gone up so much, and we're talking hundreds of percent, and it's taken decades to go up. Nobody said, after huge gains in housing markets, say in 2 or 3 years, nobody said, well, this is the peak. Some people have, and they got it wrong, including myself. and then it goes for another year, and they say, all right, well, it'll probably peak into the next year, and then it'll level off, or it'll turn back down. It's like nobody ever says that. They're a lot more biased towards saying it's going to continue to go up and maybe just slow down, so it's not going to go up by 10-15% a year, but it'll go up by 2 or 3%. But when it's going down, somehow this downturn is over, and it's just around the corner. It's just maybe this year. If they cut the rates, maybe we'll bottom out this year. If they don't, we'll probably bottom out next year. I don't know why people think that. It is very possible that this downturn is going to go for another 10, 12, 15 years. That's a long time to hold on to the property if you're trying to sell and you're thinking, and a lot of people are trying to sell and they're thinking, well, I can't get what I'm asking for. I know people personally, so they're saying, I'm just going to rent it and wait for it to pick up. Well, this is the key. Wait for it to pick up. Why do you think it's going to pick up within a reasonable period of time? If you think reasonable period of time is 10 years, well, then you wait 10 years. Because it could easily be 10-year downturn. That's how they are. Just ask Japanese.
When it comes to that, confidence in the housing market obviously tied to job security. What are you seeing anecdotally in terms of how confident people are feeling about taking out loans?
Well, at the moment, confidence is lacking in the market, particularly from property investors. Now, fortunately, we can say that there's not a lot of confidence due to a rise in defaults, which usually occurs as a result of job losses. So we're still seeing very low housing defaults in the market, which is a good thing. The confidence overall is certainly lacking, and it will continue to be weak this year because I think there's a lot of uncertainty around the election and what that actually means for property.
And in terms of that uncertainty, are you seeing that play out in the market? Particularly, are you concerned about the quality of jobs that are being created and in particular sectors?
I think certainly there's a lot of uncertainty playing into the market this year. We've got as we've mentioned, the federal elections. We've also got the China slowdown to contend with, the global deceleration as well. So I think all that is feeding into quite a difficult outlook for 2019.
How big a risk is the slowdown in China?
It's very material. And the problem is that China now knows the limits of its debt capacity and is unwilling to overstimulate the economy the way they have done in the past. And so we're in a natural progression down to lower growth levels, and that's obviously causing problems internally within China, but also massive problems for the rest of the world as the rest of the world has relied on China as its growth engine.
Louis Christopher, one of the big things that is going to be a factor for property investors and those in the market is the release of the final report into the Banking Royal Commission, which we now know is going to be next Monday. Is this tightening of credit that we've seen now the new normal due to that report on its way?
I'm not so sure it's going to be the new normal. We've gone from one extreme to the other in terms of we had very easy credit up until about the last year and a half. Now we've got the other extreme where credit's super tight. The reality is right now, if you're late for a phone payment, the bank's going to know about it if you're going for a loan. And that's not necessarily a good thing for the economy. I believe APRA is actually going to try and loosen things up over the course of 2019. And hopefully we'll find a happy medium through doing that.
And briefly then, what's your advice for those in the property market or wanting to get into it this year?
There's certainly no rush right now. There are bargains to be had, and perhaps it might be worthwhile just keeping an eye out for some extremely discounted properties, but certainly there is no rush at this point in time. The market's not about to boom, that's for sure.
Okay, so look out for extremely discounted properties. Where are they? I mean, I suppose some people that but I don't think anyone, unless they must sell, is going to sell. A lot of people are trying to sell, they can't get the price, like I said before. They are waiting for it to turn around the property so they can get what they were able to get 3 or 4 years ago. I don't think that's going to happen anytime soon. But when do those people realize that what I think is going to happen, meaning that this is not around the corner, this turnaround? B, how many of those people will actually be able to hold off selling it? What I'm saying is that how long is it going to take before they actually must sell. They have to sell because their financial situation has been exhausted and they just have to sell. They will be the heavily discounted properties, but I'm really not sure what Louis Christopher is referring to, where those properties are. And obviously had to throw that in, but he said, even he said there's no rush. So we agree there, the two experts, so-called. And more disturbing news about Australian housing. Depends who you are, though. You may be cheering.
Australia's property downturn is showing no signs of slowing down, with Melbourne chalking up its fastest quarterly fall on record. Capital cities went backwards 1% in January, with Sydney and Melbourne leading the way, as tighter lending conditions continue to dent confidence ahead of the federal election. Hobart was the best performer with a 7% rise last year, but fell into negative territory for the first time last month. Canberra was the only capital where prices aren't going backwards. To the markets, which continue.
There you go. Even Hobart, the Tassie Tiger, Hobart, has fallen down after having a pretty good year 2018, but it wasn't to last. So thanks everyone. Let's talk again.